Good evening, everyone, and it's another cold night here in the frosty Pocono Mountains, but we're warm here at the Bond Squad Lodge. Fire's going, little Stevie Ray Vaughan on the radio, and we're just hanging here, waiting for the next training day to start in a few hours, and it's a crazy time in the markets now. Now we're seeing the long rates move up a bit. There's been a lot of discussion, but before we get started, let's do our disclaimers. Investment advisory is offered through Private Advisor Group, a registered investment advisor. PAG, Private Advisor Group, is a separate entity to Wealth Strategies and Management and to Bond Squad. So here we are. We have oil prices running above 50, then back down below 50. Rigs come offline, but production was up more than expected. In fact, this is the highest U.S. production of oil since the early 70s, according to industry sources today. So much for production going offline and companies not being able to make money at these low levels. This is all about efficiencies, and it just made us think how much things have changed. We remember when it looked like domestic oil was pretty much done. The oil industry was dead. We're going to be at OPEC's mercy. Many times we've heard that oil prices are going up, never coming down. Remember the 1980s. Heck, I was in school at the time, and as everybody knows, I'm a car nut, and I'm a Mopar nut. I've had various vintage Chryslers over the years. I have an 89 Shelby Dakota, and my race car is a 99 Neon that I bought new. And a good little race car, actually. People underrate them. But what got me into the small Mopars was in the 1980s, it was assumed that CAFE standards would rise, fuel would become more expensive, and that the age of the V8 is dead. The age of high horsepower, large displacement engines are dead. So Chrysler goes out and develops a really nice engine, the little 2.2 slant 4. Overhead cam. Many people think that's a foreign design. It's actually not. It's built and designed by the same people who built the Slant 6 and small block 8s. You couldn't destroy those. A Mopar would creak and groan and made all kinds of stuff. Those engines would run forever, and the 2.2 is that too. But they decided, instead of going the V8 route the way Ford and General Motors did, they were going to go small displacement. So they brought back Carroll Shelby. He used to work with Lee Iacocca at Ford to make some really awesome cars. That's how I got my Shelby Dakota. But they decided we're going to hot rod these little 4 cylinders, turbocharge them. And they did. And out of a little 2.2, they were getting similar power outputs as the V8s in cars that were a lot lighter. And they really did well. But eventually, even Chrysler had to move away from that by the time the 90s came, because oil prices started coming down. We didn't have peak oil. We had gasoline prices falling, and the V8 cars were profitable to make, and they were desirable to consumers. So that whole oil scenario, high oil scenario, didn't pan out, and it made us think. What's changed over the years? Because we hear, pundit after pundit come out and say, this time we're going back to the old normal. This time we're going back to the old normal. Our Bond Squad's contention is there is no old normal. The normal changes. So we made just a quick list today of things that have changed over the years and that maybe have fallen out of favor or no longer exist. And the first name that comes to mind is Radio Shack. Radio Shack, as you know, filed for bankruptcy. Some of the stores will be kept open. Most of them will close. And that's a real indication of just how things have changed in the economy. When I was a kid, and I'm talking about in preteen years, walkie-talkies were all the rage, right? So you either got toy walkie-talkies with a Star Trek logo on it, or you got something that was somewhat real, and that's what you get from Radio Shack. I remember the brand name was Realistic, made by Radio Shack / Tandy, and I got my first set of walkie-talkies, and all the other kids liked them too, and that was a big deal. Then I got a 3-channel handheld CB and I could pick which 3 channels I wanted installed, and I took that on scout trips. And the kids back then, and we're talking the late 70s here, maybe early 80s, we were used to building things. You know, I came from a middle class family. We don't want for anything, but if you wanted something, you had to work for it or build it yourself. We went to Radio Shack, I remember, in Brooklyn up on 86th Street, and we bought components. When we did our stereos, we couldn't afford a high-end Fisher system as it was popular back then, or a JVC, which got popular. What we had to do is put together components with the money we had left over. Maybe you're lucky your parents got you a basic set. If you wanted to improve it, you went up to Radio Shack and you bought amplifiers and you bought speakers and you bought a receiver and you upgraded the components in there. Then maybe you bought your turntable. Before you know it, you had another set. So the turntable, there's a thing that doesn't exist anymore, right? The turntable. For any kids watching this, we used to take this vinyl disc, spin it around at 33 1/3 RPMs, and music would come out as the needle went through the grooves. I mean, I know you don't believe it. It seems like witchcraft or alchemy, but that's what we did. Well, over the years, technology became cheaper. It became more compact. I think kids became more spoiled, and now the average kid can hold in the palm of his hand a music library that would make any teenager in my day, envious. And although the quality of a downloaded song is not the same as a recorded song, record, tape, or CD for that matter, they have at their fingertips advantages that we didn't have back then. And that's what I really don't think is understood. When we look for spending to pick up, when we look for the economy to pick up, we keep looking back into traditional areas of the economy, and it's not being spent there. So let's do our list here of things that have changed, right? We have Radio Shack. So Radio Shack, except for geeks like me who still modify like old motorcycles, I need connectors and try to add modern components to 30 and 40-year-old machines. There aren't too many of us who'll do that and who need that part on demand, can't wait for it to order on Amazon and get delivered. So Radio Shack's lost its niche. We can go through vehicles, station wagons. From about 1950 through about 1984, the station wagon was the most popular family vehicle. Every family with a couple kids, in the suburbs had a station wagon. It seemed anyway. That was the most popular vehicle. Who owns a station wagon today? 1980. Reason I say 1984. That's when Chrysler came out with the minivan. It was actually a practical minivan. It wasn't the first. The Volkswagen Bus was the first small van sold in the United States, at least mini size. But the Dodge Caravan or the Plymouth Voyager brought minivans to the masses. It was more usable, wasn't as quirky as the Volkswagen. That supplanted the station wagon, and the minivan ran strong until about the tech bubble when the SUV took over. What happened in the tech bubble? Well, I remember in 1999 paying $1 for gasoline, for regular gasoline. Gee, that had something to do with it. But what it did, and it was a thing. It was an ego thing for dads. When I was younger, if you owned a minivan or even a station wagon, you're kind of dorky. Not that minivans came out when I was still a young driver, but before that, it was a station wagon or even a 4-door sedan. Nobody but dowdy, stodgy old men and grandmas getting groceries owned 4-door cars. Everybody who was cool owned a 2-door coupe, right, or a convertible. But the SUV was always had this macho look. Be the Chevy Blazer, the original Jeep Cherokee, the Dodge Ram Charger, the original Ford Bronco. These were more sport than utility. These had an image and attitude. They could really go off road too. They really were built stronger than the average car. So when people of my generation, even the late boomers, had families, they didn't want to drive around in their minivan, so the SUV became the macho family hauler, right? So station wagons are pretty much out of favor. Yeah, some companies make them, but that's changing. Coca-Cola did not have great earnings this week. When I was a kid, kids drank soda. My parents' generation, even more so. Years ago, unless you had milk in the house, but if you drank that, and maybe some orange juice in the morning. But if you were out with your friends, you bought a Coke, you bought a Pepsi, you bought RC Cola, which is like my favorite, but me and my RC. But In my parents' generation, the grown-ups all drank alcoholic beverages, or coffee or tea, and the kids drank soda. Kids don't drink soda like that anymore. Some of it's the parents, but also it's not that cool anymore to do that. You have Monster beverage, Red Bull, if your parents let you get away with it, the all different stuff, fashionable drinks, sports drinks. So that's changed. It's not necessarily bad, but it's changed. Typewriters. Who uses a typewriter anymore? When I was in college, I still type reports on a typewriter. That wasn't all that long ago. We're talking about the 1980s. I used a typewriter. People used typewriters in college into the 90s. Some people did. Nobody uses typewriters anymore, right? Pagers. Remember the pagers, the beepers people used to wear? That was probably even in the 1990s. If people needed you, they dialed your pager, beeped, you ran to a payphone. That's something that doesn't exist the way it did before. Payphones. So are we supposed to sit here and wait for the payphone to come back or the pager to come back to indicate the economy is back to its old normal? No. Time and technology march on. Landlines. All right. Few people using landlines. Even my landline telephone in my home here at the Bond Squad Lodge is really a voice over internet protocol. It is a VoIP. It is not hooked to a traditional landline. And most of my calls come through on my cell here at home. My office in Stroudsburg, that's a landline. But outside of that, nobody's using landlines anymore, not like they used to. In fact, there's one company out there, Frontier Communications, is trying to be essentially the landline company. There'll always be a need for landlines, I think, in some capacity. So they're trying to be the landline provider. It's not what it was before. Model trains. When I was a kid, every little boy wanted a model train set, right? That and slot cars. We set them up around the tree at Christmas. We had layouts in the basement. All right, how many of you out there have kids or grandkids who said, "Hey, kid, I want a model train set for Christmas"? No, Lionel Trains filed for bankruptcy like more than once. I think the last time was back in, I want to say 2009 or 2010. They still make it. They still make trains, but it's mostly guys like me or older, keeping the hobby alive. And every now and then a newcomer comes in, but those are gone. Cigarettes. I like to watch old movies. I got my wife into watching old movies, and she was astounded how many people smoked in these old movies from the 30s, 40s, and 50s, and this lit up, and it was nothing. Yeah, well, then fine. Tobacco companies can make money, but they're not what they were. They're not the big dominant corporations they were in the past. That's changed. So if you're waiting for that to come back, that's probably not. VHS recorders, I remember when VHS won out over Betamax, even though Betamax had a higher quality picture. Say, wow, this technology is the technology of the future. How many people use VHS machines anymore? How many people use DVDs anymore? Or even Blu-ray? Streaming's taking over everything now, right? We're supposed to wait that to come back. And last thing I want to mention here, because this was a big sector in the bond market, is long distance train travel, railroads. All right, freight railroads are making kind of a comeback thanks to the shale boom and all that, but passenger railroads. Outside of commuter railroads, what do you have? It's really Amtrak, right? And I think there's some on the West Coast, and then you have a commuter, like I said. But it was such a big sector that bond trading desks had transportation traders that specialized in nothing but railroad bonds. And this was common through the 70s even. My old partner, Bill Malley, when he was at Solomon Brothers, was a transportation trader. And he traded the railroad bonds. In the Penn Central, right? Missouri Pacific Railway, stuff like that. Now, what do you have? How many railroads do you have? Gee, you have Norfolk and Southern, CSX, Burlington and Santa Fe, Union Pacific. Those are your flag carriers, basically. Those are gone for the most part, except for those few big railroads. And and this is a good point. I actually didn't think of this. You have the big railroads and you have the little short lines. That medium railroad you don't have, kind of like you don't have that medium worker anymore, right? You have the queen bees at the top. You have the drones, putting the honey, in the comb. but you don't have that middle worker who goes out in the same capacity and brings back the nectar, right? You have a few of them because one bee can do the work of a lot of people, right? We have that with railroads too. You got the little short line railroads that go from the manufacturer or the mine to a switching point, and the cars are transferred right to the major roads. You don't have that regional railroad anymore. Gone are your Jersey Centrals, gone are your Lehigh railroads, and gone is the Erie and the Lackawanna. They're all gone. Grand Trunk. Not to use a Grand Funk Railroad, but maybe we'll play them next week. Right now, I'm listening to Stevie Ray. They're all gone. Is it bad that they're gone? Well, if you're nostalgic like I am, maybe, but from a business or economic standpoint, no, not really. They didn't need to be. All right. So we're all waiting for the economy to get back to normal, to jobs to get back to normal, to wage growth to get back to normal. Bond Squad make the contention it is normal, just the normal is different. Efficiencies breed lower cost, efficiencies breed lower inflation, efficiencies breed lower wage growth. They all go hand in hand. It's not bad. The arguments on TV all the time is the economy good, is the economy bad? The economy is. We're running probably about what we're capable of. Yeah. Will we continue to see job growth? Yeah, because we continue to see population growth, and the economy does improve. Is wage growth going to take off? Probably not a whole lot. We'll get into the twos, maybe tighten the labor market up a little bit. A lot of other sources of production. You have foreign central banks devaluing their currencies, and then that makes their goods, services, and workers cheaper, right over here. Probably keeps going. It's not bad. We sent out a chart showing real wage growth, and real wage growth is down not only from this recession, pre this recession, past recession. It's down below the tech bubble, and the last real wages, well, real incomes, I should say, because it counts pensions, investments, Social Security, whatever. In the last expansion, was lower than the tech bubble. In fact, the tech bubble peaked, and we've been sliding ever since as far as real incomes. That this is real and weighted for inflation incomes are lower. And we'll send out the charts. It's difficult to post them up on here, but we've sent it out in our reports and whatnot. And we're coming off a lower base, and not just a somewhat lower base, off a much lower base. In fact, we're still a good deal away from where incomes were during the last recession. Okay, before this past one. Yeah. Following the tech bubble. We're not even up to those levels yet. So households are even though their wages are going up, they're miles away from where they need to be income-wise to generate consumption-based inflation. And that goes back to our talk about long-term rates. We don't know how else we can get our point across here at Bond Squad, but long-term rates price to inflation, not to growth. All right. Most of the time, inflation and growth move in the same direction. They correlate. Might not move the same amount, but they're directionally similar, usually. Right? So it's hard to discern, are rates rising from inflation or growth? Well, it's easy to answer in two ways. One, all you need to do is look at a time where inflation went up and growth didn't, see which way rates went. Well, you can look at 1979 to 82, and you'd see on a chart that growth was basically flat, didn't grow at all. When I'm talking about flat at 2% or 3% trend, it was like zero, no growth. You had a stagnant economy, but you had inflation running double digits. That was stagflation. Well, you had a 10-year Treasury note about 15%. Obviously, it was pricing in to inflation, not to growth. Now, why would that be? Well, think about it. Why do investors want to be compensated in terms of higher yield for a longer maturity / longer duration bond? Well, it's because of the negative effects of inflation, right? If I'm locking my money up for 10 years in a bond, I can't keep, and inflation jumps, I'm locked in. I can't reinvest at the higher rates. I can sell a bond, but I'll probably get less money for it, right? So I can't. So I'm locked in. So if I'm going to be locked in, I want a higher yield, a higher rate of return than if I had a shorter maturity bond that I can roll. All right, so that means that the yield curve is what it is because of inflation, right? That right there answers your question. I had an interesting conversation with an economics professor last night, via electronic communication. That's the modern way. We don't write letters anymore. So, and he says, don't you think that it has something to do with it? And here's me explaining to an economics professor, yeah, it can, but given the choice of the two, it's going to follow. Long rates are going to follow inflation pressures. Well, they have to. That's what yields price in. So when we're looking at long-term rates, with inflation running well below 2 by any measure, it's difficult to imagine long-term rates going very high. That's not to say that they can't go higher from here. We had a new 10-year come to the market today at 2%. Could they be at 2.5? Could the 10-year go to 2.5? Yeah, you get inflation come off the bottom here, and inflation runs, at 1 and 1.5, 1 3/4. You could see the 10-year at 2.5. That's still low inflation, but it's 50 basis points on a 10-year. So, gee, what's that? 4%, 4.5%, depending on your coupon. Price decline. So the volatility is still there. So this is why we don't put all our eggs in one basket. But there's also a reason why we buy actual bonds. We sent out a little update this afternoon on the 10-year Treasury auction. And at the end of it, we said, and we made the comment that there are reasons to buy fixed income, to own fixed income, other than the traditional negative price correlation they have to equities. That's not why most institutional investors own fixed income. They can hedge it out and get negative correlation. They can hedge in ways and other ways. They own fixed income for preservation of capital and for interest income. They don't do it just for negative correlation. And that's a bad trick that financial advisors and investors have been taught, mostly through the asset allocation model. We'll allocate so much to fixed income just for diversification purposes. And that's the only reason we have it. Sorry, guys, that's bull. You own bonds for preservation of capital and income. That is the prime reason. Any diversification price-wise, really, think about it. Do you really care? If you're going to hold bonds to maturity, do you really care where they price? No, you care about locking your money, but have rates take off on you. You're locked in on a 30-year at 3.5%, and we have a spike in inflation. But if you're really investing in fixed income properly, you really don't care so much about price. But that's what people do. They don't buy actual bonds. They'll go into some managed package portfolio product, and they'll buy it'll hold God knows what in there. And then when the price moves, oh my God, my bonds are down, and people sell out, and the portfolio managers sell the bonds. And that's not why you own bonds. It really isn't. So that's where. Let's see what else we have on the agenda for tonight. We had a lot to cover here. We covered let's two other things. There's been some question: is the Fed watching wages? They're watching job growth. Are they watching Europe? Fed officials are watching everything. The Fed gets a bad rap sometimes, and they're imperfect, but they're smarter than you think. Our question is not so much will the Fed tighten because of job growth or not tighten because of slow wage growth. There's something bigger going on here, and it might not seem like it's in the Fed's mandate on the surface, but it really is. And that's the currency war that's going on here. And we saw it today in the 10-year auction. Currencies, one of the Fed's dual mandates, other than full employment, is price stability. If the U.S. currency gets too strong, we have price instability. Now, we've been taught to think, especially if we came of age in the 70s and 80s, that price instability meant inflation, rising prices, but it also means falling prices, deflation or disinflation. And the Fed has to be on guard for that, because that is actually more difficult to undo than inflation. And if you have all these central banks just easing and quantitative easing their currencies into oblivion, All right, that makes the dollar strong, and a strong dollar has its benefits. But you can't stick out like a sore thumb out there. You lose your competitive advantage. All right, so this the danger of having central bank involvement is that they try to micromanage economies. They try to micromanage the exchange rates. But if the Fed sticks out there and the dollar really strengthens, it could be a problem here in the U.S. economy. It could also be disinflationary. All right, we could see oil prices head back down again. We saw it come up into the low 50s, now in the high 40s. It's the guys at Citi think we could hit in the 20s. I heard Goldman say in the 30s. All right, well, I'm not an oil trader. I think the sweet spot's in the 55 to 65 range. Just on my own research, take that for what it's worth. But could we see lower? Yeah. And plus there's no shortage of demand. You have central banks. They bought the what out of the 10-year to 59% of the new issuance, up from I think 59.5 actually, up from 50% last time. If you're a central bank and you want to devalue your currency, what do? Well, I sell my currency, buy dollars, and put those dollars in the treasuries, right? So we saw yesterday's 3-year auction wasn't that strong, but most of the action that there was central banks. Today, central banks just carried the show. Today, you have to rate today's auction as an A. You had a bid to cover that was strong at 262, I think it was today. It was 267, but it was stronger than the last one, strongest since December. You had indirect bidder participation that was up, and you priced somewhat below the expected yield of 202. You came in at 2% even on strong demand. Then you have demographics. You have older investors and pension funds, insurance companies from around the world. The demand for long-dated treasuries for actuarial purposes, for income purposes, for preservation of capital purposes is not only strong, it is getting greater each and every day and probably will for the next 2 decades. Again, this is not to say that long-term rates cannot rise. They probably will rise at some point. But they're probably not going back to anything that resembles anybody's old normal. I started trading bonds in the early 90s, and I've always been on the retail side of the business. And I remember speaking with financial advisors and or their clients, and these clients, even some advisors, were reluctant to buy 10-year fixed income securities because, rates are going to go back to where they were, back in the early 80s, late 70s, because the Fed policy will change. We have to go back there. Back in 2004, when the Fed started raising the Fed funds rate from its then post Great Depression low of 1%, financial advisors that we covered at Smith Barney were sending us copies of a newsletter that made its way around the firm, not from the firm, it was external. Believe me, the guys at Citi who gave the fixed income outlook were really good. I mean, they wouldn't come up with this idea, but it was a newsletter that says if you look at a pattern, we have to go back to where we were. And the newsletter cherry-picked the time frame. It started at 1960 and then ended at 2004. And if you looked at it, rates went up from 1960, peaked there at 1982, and came down to we bottomed at 2004. And it was surmised that we're going to go back and repeat that pattern. 2004 would be like 1960, and the pattern repeat. Well, pay no attention to the fact that that pattern never existed before anywhere in history, and you had a much different economy and much different fiscal policies and globalization, and even in 2004 than you had before then. It just didn't seem likely to us, and we didn't. Where the 10-year go in that cycle in the fives. We had a flat curve, inverted. We were in fives across, if I remember correctly. I'm tired tonight, but that's where we were, and now we're back here. There is no normal. The normal, it changes from time period, from era to era. All right, so we're probably not going back to 1982. We're probably not going back to 1962. We're probably not going back to 2002. We're going to go where we go. And it's going to depend on fiscal policy. It's going to depend on monetary policy, demographics, exogenous events from overseas. That's what's going to set it. But if you had to make an educated guess and you looked at demographics and you looked at the broken economies overseas who have no choice other than to really make fundamental changes, which would irritate their electorate, they have no choice but to go ahead and try to out devalue their neighbors. We can't see long-term rates going up. At Bond Squad, we realize what we say differs a lot from what you might hear in other media sources. Let us be clear, we're not the media. We are fixed income professionals here. You know, we've done this for decades. This is not some wild and crazy theory that somebody's sitting, somewhere in the world who's looking at the surface of everything saying, oh, this looks like how it'll be. And that's difficult to get across because in this day of Google and Yahoo and other search engines, you can type in what you're looking for and get answers. The answers aren't always correct. And in fact, more often than not, they're incorrect. Years ago, I'm not going to give you what my pseudonym was and my pen name, but I used to post on Seeking Alpha. And I stopped because the other posters up there in the fixed income side, many of them were laughable at best and dangerous at worst. And I did not want to be lumped in, even under a false name. I did not want to be lumped in. And this is before I started Bond Squad, and it was after I left. So it was kind of in the interim, to keep myself busy in that little garden leave period. I didn't get paid for it. It was just me bloviating, right? I didn't want to do it. And I hear from FAs that, oh, I like that because I get different opinions. So, and I said, well, some of these opinions are not professionals. Well, I like that because I want to see if they see things outside the box. So looking at things outside the box and from different angles is all well and good. But would you ask your electrician about a health problem? Would you ask your doctor about fixing the foundation of your house? No, you wouldn't. If you did, probably wouldn't like the results, right? Well, that's what you're getting sometimes from these different sites like Seeking Alpha, or even from, there's a bunch of other message boards, even some of the groups on LinkedIn, which I am a member of. It's different. We had a subscriber come to us today about Safeway bonds. All right. And this subscriber is not a neophyte, is not a novice. This subscriber is very intelligent enough that this subscriber makes her own investment decisions and does a pretty good job from what we've seen. But on information gleaned from Seeking Alpha, and I need to throw them under the bus because some of the stuff there is pretty good, but you have to know what you're looking for to know what's good and what's not. Bought a bond from a company that was going through a leveraged buyout. And apparently, I haven't seen the article, the writer said that these are trading cheap for their credit rating, basically. They're a good deal. Right. What happened was the deal closed last month, and upon completion of the deal, because remember, deals can fall apart, the rating agencies downgraded it 8 notches, well into junk, and the bond prices fell off the table. And this was not discussed, and the reader didn't understand what happened. We don't go out with sales ideas or investment ideas en masse in our reports because it wouldn't be right. There's no one bond that's suitable for every investor. So how could we go out with an idea? If people ask us, and we have some people do ask us for ideas, and say, hey, if you see something, let me know. That's fine. That's unsolicited. You tell me that you want to see stuff, I will send you stuff. But it's irresponsible to do this. And if you're dealing with the credit markets, you better know the credit stories. It's not enough to say, well, gee, other triple B bonds are trading here, and we don't think long rates are going up, so this triple B 25-year bond looks like a good deal. You have to dig in. And that's why people start to use other products like funds and whatnot. But then, great, now the fund manager can do it, but he's encouraged, he's incentivized to trade. He's incentivized to take risk. He's incentivized to have price appreciation. If price appreciation on bonds, you want a trading strategy, go to it. But that's not the same as investing in the bonds. You have to know your credit stories. So before we end tonight, I'm making a personal plea that all of our subscribers, before you buy or sell a bond, contact us. We will do the research. If we don't know the answer for that particular bond, we will find the answer. Remember, all our portfolios are bespoke, customized for each account. We do the research on it. If we can't find it, we find it out there from a reliable source. We understand what we're reading. We know the credit stories. If we don't know a credit story on a particular corporation or municipality, we find out. We don't assume. All right. Our subscribers are paying for this, whether they realize or not. The $2.99 per year is not just for the newsletter. Bond Squad is your full service fixed income desk, and for a fee, we will manage portfolios. All right. The reason we're not free is that we bring value to the table. So feel free to Google things and come up with investment ideas that way. But you're probably not going to get the same type of insight you'll get from Bond Squad here. So, we don't want to see anybody blown up out there, especially our subscribers and our portfolio management clients. We're not perfect. We've had ideas not pan out for us as well, but we knew the risks. We knew what we were getting into. You can get a lot of free information out there, but you know what? You're getting your money's worth. Pay nothing, you're not really getting much in return. And with that, we ran a little bit long this week. I'm kind of relaxed. Stevie Ray's still playing there. How can you go wrong? Well, have a good night, everybody. If you want to discuss fixed income, the credit markets, interest rate markets, portfolio management, municipals, whatever you want, give us a call, 570-424-1555 during market hours. You can email me, thomas.byrne, that's BYRNE, at WSandM, that's Whiskey Sierra, the word and, A-N-D, the letter M.com. Keep in contact with us. Don't make big decisions without at least getting our opinion. You don't have to use our opinion, but it can't hurt to get an opinion from a firm, from a team that is not trying to sell you anything. None of our commentary or strategy is based on product. It's based on our clients, our subscribers. And with that, have a great night. Stay warm. It's going to be really, really cold in the Northeast this weekend. Have a happy Valentine's Day and happy President's Day. And just a reminder, because it's President's Day / Valentine's Day weekend, we will not be publishing In the Trenches this weekend. It's our time off with our significant others. I only have one. So when I say others, I'm talking about the Bond Squad and WSNM team. And with that, have a great long weekend. Good night.